In this video, I'm going to be talking about some of the things that might be potentially troubling in the future when it comes to the US and how it handles things economically. Hi, my name is Pascal Madigat and you're watching the Financial Ownership Podcast. The first thing I'm going to be talking about in this video that's troubling is the current debt that the US is in. And of the current debt that the US is in, the unfunded liabilities, if you don't want to include the war budget and things like that when it comes to the US, the top two unfunded liabilities are Social Security and Medicare. Those are one of the more expensive things in the US budget currently. And even though Social Security was never meant to be a retirement plan, because people, at the time Social Security was created, people were passing away before, people were passing age before age 65 most of the time. But now, since people are kind of living longer, Social Security is kind of paying these people longer than expected, longer than the program was expected to last. And if you look at it now, the Social Security is the number one or the primary retirement source of income for retirees nowadays in the US. So most likely what they're going to do to pay that difference back that they don't necessarily have the money yet for Social Security, they're probably going to end up just printing more money. And the problem with that is more and more money or debt is injected into the system that devalues the dollar and also increases the price of goods and services. So even though people might end up getting that, say, $30,000 or $25,000 every single year in Social Security payments, the thing is their dollar is only going to do so much because of all the money that's been injected into the system. That's only going to make the dollar less valuable. That's really the only resort the US is probably going to go towards, because it doesn't look like the US is in that trend that they're looking to cut budget costs or anything like that. It looks like it's on a trend consistently of spending more and not necessarily optimizing the operations they have now. So expect those Social Security payments, even if they do end up meeting some of those obligations for retirees. The dollar that you get from Social Security payments is going to be a lot less in the future, and that's a problem because the majority of Americans have that as a primary source for retirement. And the point number two, it actually kind of goes on along a little bit of point number one, is actually the retirement income or the retirement wealth or the retirement well-being of people that are 65 to 74. How much retirement money do they actually have? So based on some statistics that I've seen online, some statistics say that the average retiree has a net worth, not actually liquid assets, a net worth of about $250,000. It's slightly over that. And if you think about it, this isn't liquid net worth. This isn't necessarily in, say, like the 401k or some type of liquid asset that they could have access to right away. This might even be some equity in a home, maybe even a car, and all these things. So it's when you're talking about net worth, it's not just about liquid capital. It's just about all the things you have that are valuable added up, which equals your net worth. And the thing is that kind of even goes more towards that point where people are depending so much on Social Security, because how much do you think even nowadays for someone retiring at age 65, how long is $250,000 really going to last? If you follow the 4% rule, meaning taking 4% of your overall assets as income, and let's say that $250,000 was completely liquid, just to give people the benefit of the doubt, that's about $10,000 a year that they'll have by using the 4% rule to make sure that the money lasts for basically their entire life until they pass. Even by following the 4% rule, that's only $10,000. And you think about it, that's not a lot of money. And especially if you're trying to replace your entire income, the trend that a lot of Americans are in terms of saving for retirement and having certain money for retirement, it doesn't look like most Americans have enough. And they're probably going to either have to take a part-time job or a full-time job in order to sustain living in the future at 65, 74. Even some Americans don't even have enough money, and it looks like that trend is going to continue because a lot of people aren't managing or investing as they should and depending too much on Social Security. And number three, another economic factor that we might want to pay attention to is the historically low interest rate. So I've talked a decent amount about this in my channel, and the thing is, it's kind of rare that you find a situation where interest rates are so low and inflation is so high. So usually when inflation is high, to kind of balance it out, you might have higher interest rates. But in this environment that we currently live in, this is a very rare and historically rare environment that we live in, where interest rates are low and inflation is high. And the thing is, the low interest rates kind of contributes to the raising of prices of goods and services, because if you think about it, if interest rates are low, that gives people more incentive to borrow money and to use money to buy, whether it's assets or even liabilities. A lot of people, they'll use debt to buy things like purses, cars, and all these things that you probably shouldn't use debt to buy, but nonetheless, debt is accessible and a lot of people are using it. And the thing is, with the low interest rates that are now, that means more people have access to money. And when more people have access to money, that devalues the dollar even more. So it kind of makes the inflation problem worse. And there's been a little bit of talk that interest rates will be raising soon. So if you think about it, if interest rates rise, that's going to price a lot of people from different types of things in the market, whether it's cars and especially homes. If you look at homes nowadays, home prices have been increasing over 20%, which is completely insane in basically the past year. And the thing is, when interest rates rise, it's going to price a lot of people out of the market if home prices stay relatively the same. So there eventually has to be a point, if interest rates rise, that the current market in terms of the housing market drops a little bit too, because the house is only as valuable as what people are willing to pay for it, right? If no one can pay for it, a majority of people can't pay for it, it doesn't really matter that the house valuation says $1 million or whatever type of house on the market is selling for or is priced at. If people can't buy it, it's going to force the price to drop. So that's one thing that rising interest rates will do. It will speed up a little bit of the correction of the housing markets and the insane growth that we're seeing in the housing markets. And the thing is, with these low interest rates, it's going to affect businesses in terms of the rate they're borrowing money and using this cheap debt. So it's going to be kind of a strange situation, and it might cause a little bit of a correction in the economic cycles of the trend that we see of the stock market and the real estate market just going up. And rising interest rates might change some things in terms of slowing down the economy. So that's one thing you might want to watch out for and pay attention to, is the fact that there's interest rates that are so low right now that might not last forever, and that might be kind of a red flag that's going on in the U.S. right now in terms of one things you want to pay attention to. So the last factor I'm going to talk about is the gross domestic product in the U.S. So the consumption of U.S. goods in the borders, basically. The government spending is part of the equation when it comes to gross domestic product. And when it comes to GDP, the government spending is now about 30% of the overall equation. You want to look at consumption domestically, plus investments, plus government spending, plus exports, minus imports. And that will give you the total GDP, or the gross domestic product, of the current US today. And that's actually part of the way the inflation number is calculated, is how much the government actually spends. And obviously, the more the government is spending, it's only going to devalue the dollar even more. A lot of these endeavors don't operate the most efficiently as efficiently as they should. The government is just going to need more and more money to spend, because if they can't solve the problems that they're trying to solve by printing more money, they're gonna have to print more money to kind of put a band-aid on it. But I guess we're gonna have to see if the US ever has a point where it actually kind of cuts down spending. It doesn't look like it will, but we're eventually gonna get to a point where we're gonna see a massive correction in terms of the economy, but nobody knows exactly when that's gonna happen. So I guess we'll just have to wait and see, and just make sure that you're making smart investments along the way and actually have some money saved up, protected against market risk. So when the economy actually corrects and things like that, you don't have all of your money stuck in the cycles of the market. So it's important to make sure that you put yourself in a position where if the economy crashes or the market crashes, you still have access to capital that you could use, whether it's for different types of investments, business, and other types of things, just to keep yourself flexible and not vulnerable just to a market crash. So if you found some value in this video, go ahead, like, comment, subscribe. I post financial content every single week, so If you ever want to learn more about personal finance, this is the channel to follow. So feel free to either leave a comment below to ask me a question, or feel free to book a call. I have in the description below, there's a strict description to my link tree. If you want to ask me any type of question or contact me, feel free to contact me there. Thank you.